Healthcare going from first to worst. Healthcare, as you remember, the best performing sector in 2018, but has lagged the broader market this year, up just 6%, while the S&P is up more than 11%. One top technician says there is one name, though, that you can play for a catch-up. Let's go straight off the charts with Rob Sluymer of Fundstrat. Hey, Rob, what are you looking at?
Hey, Melissa. Let's start with the market overview, because I think it's really important we get a sense of where we are in the market cycle. Then we'll start looking at some healthcare stocks. So as a starting point, the S&P, this 200-week moving average, that 4-year moving average, is a very good long-term proxy for support for the market through secular bull markets. We believe we're in a secular bull market. In the 50s and 60s and the 80s and 90s, that provided support pretty consistently all the way through those 2 decades, each of those 2 sets of 2 decades. So what we have here, back in 11, the market bounced off the 200-week. In 2016, it was almost a perfect setup. And then coming into December of this year, we had the market almost within a couple of points bounce off that 2346 level. So what we think is developing are these sort of business cycles, market cycles, and we think the market's in a much longer term upcycle here. It should last another 2 to 3 years. So what do you do here? The market's up 20%. Growth stocks have ripped to the upside. Cyclicals have bounced back very strongly too, and increasingly from a tactical, from a trading standpoint, most of those names are not particularly timely. We're not negative on them. We want to add to those stocks on pullbacks, but right here, right now, what do you do? So let's talk about healthcare. It has been a laggard over the balance of this year, but when you look at this long-term relative performance versus the S&P 500, it's still in an uptrend, and yes, it has underperformed a little bit here this year, but not all the stocks look like that. So what do you do with a market up 20%? Cyclicals have ripped, growth has ripped. I think you come back to some boring names as you move into the second quarter. Look for names that are sort of stable, steady growth, some decent dividends. And we look at what Pfizer's done over the last little while. It's come right back to that 200-day moving average into a tremendous amount of support. It's had this big correction through 18 while everything else has ripped. This stock's pulled back. We think it's really timely. And if you look at that relative performance, all the way back to that relative trend that we had in 18, and it's starting to hook to the upside. So names like this, a couple other stocks like CME have all pulled back in the first quarter. They're quality, they're at trend, they're very timely here. Now, in contrast to that, and healthcare is a very diversified sector, lots of different things happening. The HMOs are an area that we're still concerned about. Now, we've highlighted these for the last 2 weeks in our notes to our clients. They're starting to roll over. They've been hit very hard in the last couple of days. I think United's down something like 10% over the last 5% each of the trading days. And it's probably getting set up for a bounce off this point. However, when you look at that relative performance, it's breaking the lower lows. So the concerns around the HMOs, I think, are going to last for a number of months. We'd be fading this stock, take that capital, put it into Pfizer. We think it's a much more timely trade, not only from the standpoint of a paired trade, but for the market overall.
Rob, why don't you come on over to the desk? Shelby will bring the chair.
Good decision,
Thanks,
Mel.
Thanks, Guy. Not that it matters what you think.
Welcome.
All right.
Good to see you.
Hi, sir.
How does biotech look?
It's very mixed. If you look at a lot of the mid-cap names, they're ripping to the upside with a lot of the growth stocks. Many of them look fine. Some of them are getting extended, but I think you're probably asking about the really big-cap names like Celgene and Gilead and Biogen. I think many of those names haven't participated in the rally. They had their peak in 2015, and they're basing out. So if you look at names like Biogen and Regeneron, I think those are actually pretty timely names, lower risk going into the second quarter.
Do you see a test? And I know the numbers have changed and the retracements have changed.
Yeah.
And what we're looking at from that December low, things have dramatically changed, predominantly with Powell and the Fed. So 2350 can be off the table, but do you see us coming in anything dramatic from here?
I don't think it's going to be a dramatic pullback. If we go back to 2016, I think the setup is very, very similar. The Fed's on hold. China's stimulating. The concerns over a global recession are behind us. Cyclicals have ripped off the bottom, and I think you could be maybe looking at a 5% pullback in the second quarter, but I don't think you're coming all the way back down. We were never in that camp, and we think that whatever pullback is going to be shallow, very churning, very sector rotation. That's why we like Pfizer here.
So Rob, if you're looking for sector rotation, are you disappointed in the way that bank stocks act? Are you disappointed in the way that MAGA acts? That's Microsoft, Apple, Google, and Amazon. I mean, they just don't get going, and they seem stuck in the mud. Yeah, just want to make sure.
Right. So look at Microsoft, sort of a quality name, led into the correction, and is pulled back. It's actually pretty timely here. So is Amazon. Quality, big cap, liquid names, not the accelerated growth in cyclicals that we've seen coming off the bottom in January and February. So I think they're actually pretty timely names right in here. Apple, around the 200-day, I don't think you got a lot of downside in those stocks. So I'd be putting capital there. Pfizer, CME, it's all kind of the same trade. A little bit less accelerated growth, a little less cyclical, probably pretty timely right at these levels.
Any thoughts, Rob, and this is sort of out of the blue a little bit, on Tesla, since we are expecting the stock to reopen in about 5 minutes' time?
So there's another name. It's a bit of a different animal. It's not the same sort of quality, defensive, dividend type name, but it's down a lot. It's in a big trading range. I have to agree with Guy. I think it's actually pretty timely here.
Timely meaning?
On the long side.
Okay. All right, Rob. Thank you. Rob
Thank you.
Sluymer of Fundstrat. I don't know where you want. We covered a
Big cap
potpourri.
pharma. Big cap pharma, Mel.
Okay.
Because you
What
said,
about
where do you
it?
want to go? We covered a lot. Where would
We
you?
did, yes. So where in big cap pharma?
So it's very interesting,
Pfizer,
and I'm
which is
glad that you
maybe-
mentioned that. So Eli Lilly, it's its own animal, that has been significantly through its all-time high. We've been bullish Pfizer. Look at both Pfizer and Merck, though. Pfizer is within a whisper of the all-time high it made in 2000-ish, which I think was 46.5, 47, and Merck is within a few dollars now of its all-time high, made it basically exactly the same time. In terms of big cap pharma, ex-Eli Lilly, you are talking about the potential for the double top of all double tops. And if that were to happen, I'd say watch out below, folks.
Should we be concerned about some of these managed care stocks? Rob had pointed out UNH, for instance, losing ground a lot in the past couple of days because of this Medicare for all.
Yeah, I think it's a huge political thing. So you have the hardcore left liberal side pushing for Medicare for all, but it's never going to pass. So the stocks react first to the rhetoric, but there could be a lot of dynamics where at least this rhetoric is heard. It'll never get passed. So I think this is a buying opportunity in HMOs.